Jim Tierney is CIO of U.S. Concentrated Growth at AB, and Nancy Tengler is still with us. Jim, welcome. Good to have you with us. I mean, my sense is that you think we're due for a pullback, but that doesn't mean we're going to get one.
I think everything that you saw post the election sort of made sense in terms of stocks rallying, the expectation of less regulation, business confidence is up substantially. The consumer was incredibly healthy this past weekend based off on overnight numbers. So it feels like everything's moving in the right direction. Yes, stocks look expensive relative to their own history, but that's never been a great reason to sell or a great reason to have too much concern unless there's a catalyst. And I just don't see the catalyst right now.
What about interest rates? Excuse me, particularly on bonds. I'm not speaking so much about the Fed funds rate and so forth, but what about interest rates and whether those higher rates and higher stock prices can coexist?
As you can see from my gray hair, I've seen a few market environments, and I think back to 2000, and interest rates were 6% then, and a 25 multiple on the S&P 500. That was really extended, but it was because of the earnings downturn that you actually saw what happened to the equity markets. At 420 on the 10-year, I just don't see things as that extended today.
I see Nancy nodding.
Yes. Well, I'm going to tell Jim, never let them see your gray hair. That's my strategy. Yeah, I mean, I've drawn the analogy, as Jim just did, to the 90s, where we coexisted with higher interest rates, so 10-year between 5 and 8%, Fed funds rate above 5% for the entire decade. And so what we saw was stock price performance that was outstanding until it wasn't, but it lasted for a very long time. I think we're in that same productivity-driven growth environment, and I do think it can continue for some time, though I agree with Jim. We need to see a correction every kind of 12 months, 10% on average, to let everything recalibrate. But in general, we still think we're in early days of a 90s bull market equivalent.
Now, the only thing, Nancy, I wonder about is, I'm trying not to quote these off the top of my head, but when the forward PE is basically the highest it's ever been, with the exception of, maybe .com, or, when the Buffett indicator is at its highest since 1929, or when, the proportion of Americans piling into stocks is also at the highest it's been since the 90s. All of these kinds of things are taking place. Obviously, you still have to be in the market, but do you do anything tactically in case 2025 isn't as good a year?
Yeah, I think this is a stock picker's market. But remember, too, there's almost $7 trillion in cash on the sidelines. We also know that earnings growth came in much better than expected. Average PE multiple on the equally weighted S&P is at 18 times. Historically, it's been at 17.5 times. So I think what you want to do, and then there's also been an analysis done of the number of stocks trading at a multiple above 50, and we're well below 90s levels. So I think what you want to do is own the right stocks. I think Jim would probably agree. He probably thinks he has them in his portfolio. I think I have them in mine. But you want to own the reliable growers with the great management team.